Hello everyone and welcome back to the channel. Another episode on options trading. It's earnings season, so we're doing this special series on how to trade options, and what we're doing is a straddle or strangle type of strategy. We're buying both a put and a call, and mostly trade stocks. So we want to kind of expand our strategy, especially earnings is a great opportunity to make money off of volatility. And buying a put before earnings can help you take advantage of that volatility. Remember, this is not financial advice. The disclaimer is in the description below. I'm doing this for entertainment and education purposes only. I'm doing this on paper right now, so I'm taking this earnings season to learn this strategy, to analyze the charts, see if my analysis fits into this strategy, see if it's profitable, because as you're going to see, this trade is going to be a little different than the Disney trade. The Disney trade was profitable immediately, but you'll see Walmart's a little different. What are we going to do? Let's jump into the chart and find out. And there you have it, Walmart on the docket. Yes, there's a lot of lines on here. We need them, so I just drew this before making this video because I'm going to need it to explain certain things. So what I'm doing, part of my strategy, is I'm going back to the earnings and I'm drawing a blue line to identify when that earnings happened. Okay, so here we have 1, 3, 6, 7. So we almost have 2 years of earnings to analyze, to observe, detached observer of what is the behavior after earnings. Do we get a huge gap down? Does it take time to develop? What would be the best strategy for in terms of profitability, and which security, which option should we choose that would fit in that frame? So we identified the earning dates. Now, one thing that jumped off the table right away was it doesn't do much right away, but it tends to trend downwards after. There's 1 out of 8, right? Maybe 2 previous earnings. If I scroll back a little bit, maybe this earnings. Oh no, this earning trend down too. So I'm most likely to bet that we're gonna have a sell-off after earnings, and as you can see, it's a slow bleed. Only in this situation here in August that we had a run up. Okay, so after earnings, there's a bit of volatility. Here, there's one time that we had a huge gap down after earnings. And then here, we had a huge gap up, but it's a breakdown candle and a sell-off. So now that we know that it's most likely going to go down, but again, earnings is the wild, wild west. I'm not going to bet on it, so I'm still going to buy my call. But I know that we're going to be going in the downward directions most likely. And that's where the bigger profits are going to be, and that it takes roughly 12 to 30 days to fully mature, to come to a final destination. That's the cycle. It seems that's the pattern, that's the cycle. So am I going to buy an option that expires in December? No. So I had a comment in one of my videos, like, why did you buy so far out? Don't you want an option closer, that will expire in a week or two, so you can make more money on the volatility? And the answer is, well, yes, you can make more money, but also the option expires faster and goes to zero faster, so we don't want that. So in this particular, after analyzing this and after seeing before we get into the prices of the option, but so every earnings, right? So we started from here 127, that's a $10 move, right? Here 135 to 151, $15 move. Here 151 to 142, $10 moves. And you can see, I'm not going to go through all of these, but roughly we're looking at $10 to $20 or $10 to $15 moves. So we want to keep it. We're going to want to keep it for 15 days at least. So maybe after 5 or 10 days that we see the stock moving in our direction, maybe we'll sell the call, maybe not, maybe I'll just keep them both, who cares, right? We're going to make money regardless, but I don't like starting to buy and sell and try to unravel these things. It kind of we'll get to that with more experience. Really, we're just doing this on paper, focusing on the strategy and how to apply this strategy depending on the stock behavior, right? Every stock behaves differently. You can see here, this one takes time. So I'm going to get an option that is in March there's the Januaries, but then it goes to March. So we're going to pick these up. We're going to pick the 145s calls and the 150 puts, and they're both roughly the same amount. This one's 885 and this one's 845. On Monday, the price will change. This is a rough estimate. There shouldn't be much difference in terms of the pricing, unless we have this huge gap. So if we go to our spreadsheet, so let me just flip it over. That'll just take me a second, so I got to open up my spreadsheet. And there we go. There's the spreadsheet. So like we did with Disney was a 25% return on investment. Literally risk-free, because we're playing both sides of the market, and this is a really nice strategy. I'm actually liking this a lot. I'm happy that I'm learning this and I'm doing this on paper and I'm doing the homework to figure out if it's going to fit in with my style, and it seems like it will. So most likely, a $10 move, your call option in a month's time, that may be worth, we'll say, just like the Disney ended up being worth $1.20. We'll use that as, maybe it's $1.55, we'll say, right? And then they move $10. A $10 move on $8. So we're probably going to need more like a $15 move to whoops, this should be 18. Yes. So this strategy may be a little less profitable. So I think, we would need for this to be maybe, it will probably be roughly around that, worth roughly that amount in a month's time. So this one may be a little bit less profitable, so we may only be making about $300 on this, but roughly a 13% 15% return on investment. Still good for a 20-day investment, so strategy. So, this is basically the prediction that I'm thinking. It's fairly conservative. I think I gave it the call option a fairly low price, and $15 move, that's 66% of the value. So I gave it 10, right? $10 to add to that option, which gave me a $2.35 profit per on the contract for a 13% return on investment. So a little conservative. I thought I was going to see a little more, but that's okay. That's totally fine. So tomorrow we're gonna execute that strategy, and we'll see. We'll keep it for a minimum of 20 days, 20 to 22 days, or a $10 to $15 move. And if at any point before the 20 days, if we're in profit more than $250, we're going to just close the position, because right now that's the forecast. So if we have something like $300-400, I'm absolutely going to close my position. I'm going to take that because it is I overshot my target. So we're going to keep doing this. subscribe, comment, like the video if you want to follow me through my journey. You want to do this with me, on paper if you're learning, or if you're already experienced and you just want to go ahead and do these because you know the risk, right? That is involved with doing such a strategy. Go ahead, right? I'm leaving that totally up to you. If you want more personalized coaching, I do have a Patreon account that you can subscribe to. I have different tiers there. I have a lot more products and services to offer. If you're interested, you don't have to. It's totally up to you. But thank you for watching, and I'll see you tomorrow.